Alright, Jim Schultz here for my Finance 512 class. I wanted to shoot another video. This time I want to take a couple of minutes and go through how to begin doing fundamental analysis. I know that in my feedback from some of you via email or coming by the office or whatever, you guys are kind of struggling in terms of how to get started with fundamental analysis. I know I mentioned some things in class, but with the semester just being underway, I thought it would take a few minutes and kind of give you guys an idea of what I'm expecting you to understand from what you learned in Finance 311. And you know, I understand that many of you don't remember anything from Finance 311, and that's not good, to be honest. I kind of hope that you would remember some things, especially the students that had me for Finance 311. But nevertheless, I am absolutely here to help you out. So if you're struggling with anything, definitely let me know. But hopefully this video will help you out. So what I'm going to do here is I'm going to I want to compare. So here's what I want to do. I'm going to do some fundamental analysis comparison, right? So let's say that I've decided, all right, I want to invest in either Starbucks or Panera. Okay, now actually let me move that over a little bit so I can. This is, you know, maybe it doesn't really matter how you determine that this is the comparison that you want to use, but this is kind of interesting because you'll see in a second here that these companies are actually in the exact same industry, and so they are direct competitors of one another. And you know, that might make sense to you when you think about their business models and what they're trying to sell you. Obviously, Starbucks is more known for their coffee, and Panera, while they sell coffee, I would argue is more known for their food, but they both sell coffee and food, and so you're going to see they're actually in the same industry that's called specialty eateries. And so we're going to look at that in a second. But let's say that you say, all right, I'm going to compare Starbucks and Panera. Well, what dimensions, what criteria am I going to use to compare them? Now, keep in mind, this is just an example. This is a very small sampling of what you could use. But I'm going to use some terms that you should be familiar with from 311. So maybe something like beta. Maybe I want to learn, hey, what is the beta of each company? You know, are they drastically different? You know, are they pretty much the same? I want to learn about that, right? And you know, hopefully you're thinking, oh yeah, beta. I've heard of beta before, right? So that, you know, hopefully you're having that feeling. Next, you're thinking, all right, I also want to look at the PE ratio of both stocks. You know, you should remember a lot about PE ratios from 311. We will talk a lot about PE ratios in 512. I will quickly review what you learned in 311, and we will build on that in some really interesting and unique ways in terms of how to use PE ratios in your fundamental analysis. So I want to look at beta, I want to look at PE. Maybe you also want to look at something like return on equity, right? And then maybe you also want to look at profit margin. That we'll just abbreviate PM. So maybe these are the essentially, you've got the industry, but then you've got 4 additional criteria that you want to use to try to make your decision, right? In terms of, all right, which company do I think I want to invest in? And so I'm going to add in a column here that just says advantage, meaning when I go through beta, I'm going to say, all right, what is the beta of Starbucks? What is the beta of Panera? And then for what I'm looking for, which one has an advantage? Which one looks which one looks healthier from a financial standpoint? Because remember, fundamental analysis is all about measuring the financial health of a company. Whether it be through statistics, which is what I'm using here today, or it could also be through things like news articles or earnings calls, like what you guys are going to do on Wednesday, or anything like that. All right. So what I would recommend you do next is I would recommend you pull up, you know, just pull up the old interwebs here, and obviously I use Google Chrome because Google Chrome is the best browser. If you are still using Internet Explorer, that absolutely baffles me. You should get Google Chrome immediately. And so, okay, so obviously we've got a new tab opened up. So here's what I want to do. I want to go to Yahoo Finance, right? So it's finance.yahoo.com, right? So I want to use Yahoo Finance to do my quantitative fundamental analysis. All right. So here's what we're going to do. I'm going to go to Starbucks, SBUX. All right. Boom. All right. So what do I learn about Starbucks? Well, if you just look at this, main page here that you can see, on this page, there's a lot of information on this page, right? But what do you see right away? I see beta and I see PE. Now don't worry about the TTM. I will explain what that means in class later on. That does stand for trailing 12 months, and I will explain that when we get to the PE section in class. For right now, don't worry about it. Just use the TTM PE for your analysis. So I'm like, all right, my beta is 0.82, and my PE is 30.62. So let me go ahead and mark those down for Starbucks. The beta here was 0.82. And then the PE, if I remember correctly, was 30.62. All right, so we're filling in that information. All right, so here's what I want to do next. I want to pull up Panera immediately. So this is Panera, PNRA. Boom. Let's see how Panera stacks up. All right, so Panera beta of 0.89, PE of 29.98. So what do you see? You see some pretty similar numbers here, right? No question. So let's see. This was 0.89. This was 29.98 maybe? Let's double check that. Yeah, 29.98. Alright, so before I go any further, I want to stop a minute and analyze these results. First of all, what does beta measure? Well, if you don't remember, then you should look back in your 311 notes. But let me give you a real brief review of beta. Beta basically measures the systematic risk levels of that company relative to the entire stock market, right? And if you remember from your beta studies in 311, 1 is the critical reference point. If a company has a beta of 1, then it is equally as risky as the whole stock market. In other words, if you invest in a company that has a beta of 1, your company's performance, stock price performance, should be roughly as volatile as the entire stock market. If the beta is less than 1, it's going to be less volatile. If the beta is more than 1, it's going to be more volatile. Okay? So maybe when you started this analysis between Starbucks and Panera, you were thinking, all right, I think I want to take on some risk, right? I want to find a risky stock. I want my stock to be volatile because remember, more risk, more return, right? So you're thinking, all right, so when I look at these two, I mean, when you look at these two numbers here, right? You got 0.82, 0.89. Panera is technically riskier, yes. But I'm going to put this as a tie. Because in my opinion, we're really splitting hairs. We're talking about a difference of 7/100ths, and so it's just not that big of a difference. So in my estimation, from the beta dimension, we have a tie. Now, what about the PE? Now, what do you see? You see the numbers are almost identical, right? So obviously, we can go ahead and write tie in there. But what does PE measure? This is critical that you remember from 311, so that you're able to keep up with us when we talk about this again in 512. PE, remember, the P is the price per share, and the E is the earnings per share, right? So the PE ratio basically measures how much you have to pay for every dollar in earnings you want back from that company. So Starbucks has a PE of 30.62. So I got to pay a little over $30 in terms of share price, right? I've got to pay $30 to get a dollar back in earnings. Whereas with Panera, I got to pay a couple cents under $30 for a dollar back in earnings, right? Remember, the higher the PE ratio, the more expensive the stock, the lower the PE ratio, the cheaper the stock. And so maybe you were looking for a stock that's really risky, but that maybe is kind of cheap, right? Again, not a big difference here. I'm going to label this as a tie. You could say Panera is cheaper and riskier, but it's so close, I don't really feel comfortable doing that. So we're going to stick with the tie, so we don't really know what we're going to do yet. Alright, so next I'm going to, actually before I move on to these two, let me fill in the blank here of the industry. I told you earlier that it was specialty eateries, but let me go ahead and show you how you would learn that on your own. So I'm on Panera. This left-hand side here is very, very helpful. You click on the industry, and what do you see? You see Panera, industry, specialty eateries. Now let's go to Starbucks. SBUX, obviously. Industry. Specialty eateries. So now you have two companies in the same industry. So that means you have found two competitors, which it's usually easier to analyze two competitors. Now you can analyze two companies from two different industries, and I'm sure we will do that. But for our first example, I think that this is a little bit better. Okay, so now that I'm already on the Starbucks page, how do I navigate to Starbucks return on equity and or profit margin? Well, it's not going to be on the home page for Starbucks. What you're going to have to click on is this key statistics tab. So key statistics. Now, when you scroll down, you're going to see just a whole wealth of information, right? And some some repeat of what you learned before. I mean, there's your trailing PE, there's your beta, right? But let's go down and what do you see? I see return on equity. Again, TTM, so that's trailing 12 months. I got 29.15%. So let me go ahead and write that down. Return on equity, 29.15%. Now, what is the profit margin for Starbucks? You're going to see it's on the same page. It's right up here under the profitability section. Profit margin, TTM, 10.41. So let me find my Microsoft Word here. I got a lot of things open. So this is 10.41. All right. So let's find those same numbers for Panera before we talk about what those numbers mean. Panera, I got to the Panera page. I click on key statistics. And what do you see? Scroll down a little bit in the same places. Return on equity, TTM, 22.93. So let's write that down. $22.93. And again, we'll analyze that in a second. Profit margin, 7.81. And then obviously just for completeness purposes, we'll just say that these are both specialty eateries. Alright, so what do you see? Alright, what is return on equity? Well, remember, return on equity, the equation is net income divided by equity. So what this basically shows us is how much money we generate in net income per dollar of equity. So if this number is 29.15%, what that means is you're generating a little bit over 29 cents for every $1 in equity. So obviously the higher number the better. So there is no tie. It's very obvious that Starbucks is doing a better job than Panera in terms of the net income they are generating per dollar of equity. And so Starbucks gets the advantage. Now let's go down to profit margin. Now what about profit margin? Well, profit margin is net income divided by sales, if you remember from your 311 studies. So this basically measures how much do we generate in net income per $1 of sales. So if this is 10.41%, that means that we are generating a little over 10 cents per $1 in sales. Whereas here we're not even at 8 cents per dollar in sales. Again, obviously, you want to see a higher number in a ceteris paribus situation. And again, ceteris paribus means all other things being equal. So once again, it's very clear. Starbucks has the advantage here. Those are pretty far apart. Like, that's substantial. We're not talking about 700ths like we were there. So again, I've got an advantage for Starbucks. So now, what do I have on my hands? The winner, obviously, is Starbucks, right? Now, we've only taken into account 4 different ratios, right? So, I mean, are you going to definitely make money by investing in Starbucks? No, not necessarily. But here's the importance of doing analysis like this. This took me 10 minutes, right? From just looking at a few ratios, I have now built a very solid thesis for investing in Starbucks. And this is how you improve. This is how you get better. You build a thesis, then you make a decision. Then later on, at some point in the future, you evaluate that decision to see if you made any mistakes, to see if you could improve, to see how you could possibly get better and become a more seasoned investor. Right? Now, if you did this on a trade report now, you would get a 10 out of 10, no question, right? Because this is very thoughtful, it's very systematic, it's quantifiable, it's a lot of the things we're looking for in really good analysis. So hopefully this little tutorial was helpful for you all in terms of how to do basic fundamental analysis. And yeah, I'll see you guys in class.